Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Today, you asked for it, guys. I've been getting questions left, right, and center. My thoughts on the acquisition of Blackwater and Daunia mines from or by Whitehaven Coal. So I'm going to get into it. I'm going to give my take. Disclaimer, nothing I say is advice. It's just me sharing my opinion. Okie doke. I can't believe there's so much controversy about buying decades worth of cash flows for 2 to maybe 3 times EBITDA. But anyway, we'll go through. I'll give you my thoughts. Direct you to 2 main resources I think are really good. Had a great take on this. The first is this piece here by our friend the Koala. He and I have been chatting about this offline. Yellow Life Capital. I'll leave a link for you guys to check it out. This was written before, so on July 3, before the acquisition, and I think it was a really good setup, encapsulated market sentiment, and took a look at extrapolated as much as you could without knowing the final numbers. So we know the final numbers. What are they? So Whitehaven will acquire everything, 100% of the 2 mines. They're met coal mines. So this will put Whitehaven from a thermal coal producer to a met coal producer for a total of $3.2 billion. And how is that going to be structured? 2.1 bill up front, payable on completion of settlement. And then you'll have an extra 1.1 billion in tranches over 3 years. Okay, so 500, 500, 500, and then 100 mil. The thing that caused a little bit of confusion is the contingent payment of 900 mil. Okay, so 3.2 bill potentially then would become 4.1 billion. Now, this will only be payable on the realized pricing exceeding agreed threshold. And in the footnotes here, you can see the payments, 35% revenue share, okay, subject to average realized price by the assets of over $159 a ton in the 12-month period post-completion. And then in the following year, it drops down to 134. And then after that, it's 134. In the third year. Okay, so maximum that would need to be paid in any given year would be $350 million US. Okay, so if I were valuing this, I would just throw it all into the price, and then whatever doesn't need to be paid is obviously gravy on the top. Funding. So how are they going to do this? This was a big question that people were saying, well, no bank is going to want to touch a coal mine in terms of lending, because that's where we are at current state of the world. And so there was talk, the Koala modeled out a possible vendor finance option, which would have been absolutely delicious if you could get that, done. However, what they have come up with is they will have cash consideration, and then they'll have a bridge loan that'll be paid out over the year. And then the expected cash flows from the operations will pay out the rest of the tranches. That's how I'm reading it. I've done this before in private businesses, so it makes a hell of a lot of sense. It's absolute gravy because you can essentially pay a proportion of the purchase price out of the future earnings. Okay. So far, I'm not going to go into the macro or the meso. You guys know what I think about coal. I've spoken about it with Rick Rule, I've spoken about it with Fergus Cullen. Met coal, I don't think is going anywhere. I think there's still a strong demand. The only thing I potentially would be worried about is the bloody Australian regulatory risk of if they start to renegotiate royalty agreements or slap on some kind of windfall taxes, which could be an issue. So the Koala starts off with his valuation and said, look, well, he thinks multiples of 2 times EBITDA are appropriate for one of the best assets in the world for this type of stuff. And he's correct, given the current market. I just find it hilarious that I used to be able to buy like little private owned businesses, small businesses and that'd usually be anywhere from sort of 1 to 3 times EBITDA is what they put on the asking price. And here you can effectively buy one of the best assets in the world with the same valuation. It's a little bit it's a mindset shift, and that's why I don't operate much in the private sector anymore, because I figured, I rolled up, sold, and figured, well, where am I going to park my cash if I can do this? Why am I going to go through all the headaches of working in the private sector? But anyway, publicly listed businesses, there are opportunities if you know where to look. But I think this is a key thing. People who invest in the stock market generally just want to see their equity go up. And that's fine. I do too. That's all wonderful. But you got to understand, these are bloody businesses. And I come up from a private investor, entrepreneurial standpoint. I'm looking at what that thing can actually produce me, and how we measure that is cash. Yes, there might be an asset valuation to see what kind of hidden value could be unlocked. But at the end of the day, I spend cash. And if I'm going to put leverage on the deal, I go to the bank and I'm going to have fixed cash payments. And so the cash flow is the lifeblood of any given deal. For me, anyway, the way that I look at things. So if we look here, I expected 2 times EBITDA. I expected the price to come in around 2.4 bills. So it's a little bit more expensive than that. However, and this is, I'd absolutely, if this had gone through this way, I mean, I would have put in even more into this company. So the koala proposed $1 billion cash up front, and then essentially vendor finance the rest. So 80% after tax free cash flow payments to pay out the old vendors. That would be a truly phenomenal deal structure. And koala, if you're ever wanting to run a PE fund, let me know, because I'd be very interested in investing if you can get that kind of structure happening. Anyway, you get the point. Scrolling through, I think this is the big one here. So you wake up in 3 years and you got full payback on your initial investment. This is the thing. Everyone's getting caught up. Maybe it'll be 4 years, maybe it'll be 5 years if we have this recession and the met coal prices are a little bit softer than, or not a little bit softer, if they really tank more than what even consensus is expecting. Consensus prices using this deal works out to be around 2 times the EBITDA, okay, 3 times the cash flows. This is the way I look at it. You wake up in 3 years, you got your full payback on your investment, and you've got decades left of free cash flow. If you saw my video on Meg Energy, the thesis in a nutshell was this thing's got 30 years worth of inventory at stay flat production, and you can buy it today. I believe that it was roughly about $80 oil when I was making the video. Might have even been less. No, it must have been less. It's been a while. $60, $70 oil, and you're buying this thing for 3 times the current cash flows. You decide. You tell me whether that's a good or a bad deal. That's the way I look at it. Okay, so that's that from that sort of thing. Let's go through anything else I really wanted to say. So I mean, 17 years and more than 50 years on a mine that you're buying at 3 times cash flow, 2 times the EBITDA. I mean, I don't know. I don't need to hear much else. I mean, yes, I guess there's the regulatory risk, and there's the risk of the management going and thinking that they're geniuses and going and doing another acquisition that's not as good, and they mess up somewhere along the line. I don't know. I don't see that happening. They've been doing a lot of buybacks. They've been doing a lot of shareholder returns. That's wonderful. I enjoy that as much as the next person. But really in a position now where you just aren't going to be able to get your hands on this stuff, and to have a high quality asset base with the infrastructure. I don't know how much CapEx has already been spent into these mines. I'm sure it is a lot. You're getting all that sunk cost for free, and everything else is all upside. So anyway, in a nutshell, you can probably stop the video. I'll go into a little bit more detail, but honestly, this is what I think on the matter. Disclaimer: I'm a shareholder. Highly accretive. Everyone says that. I've never seen a management do an acquisition and say, "Oh, yeah, that's actually not accretive, boys." It's but we've diluted you for nothing. But having said that, I tend to agree. Looking at the numbers inside out and back to front, there's no other way you can really come up with it. unless you really believe the doomsday is that met coal will be finished in 3 years. Personally, I don't believe that. So anyway, there you go. So whether you look at the current spot, the valuation multiple is at 1.8 times EV to EBITDA. If you look on what happened on the trailing 12 months, 2.5. And if you look at, I guess, consensus for the pro forma of 2024, the deal goes through start of financial year next year, which will be 2024, three times EV to EBITDA. Yeah. I don't know what you want me to say. Other than that, I'm just praying that management doesn't screw me over, like I am with basically all of my publicly listed business investments. Strategic growth options. That I don't love the sound of that. I would love them just to get their hands on this big asset and then say, you know what? After we've paid back for this acquisition, we're going to give. I'd like them to be firm on what they're going to do with regards to shareholder returns. So that's that. This reminds me, actually, props to my good buddy James McKay. He and I met in Playa del Carmen in Mexico, and we were talking about all sorts of stuff. But then somehow coal came up, and he said, no, these guys, Whitehaven, they might talk a big game in terms of shareholder returns, but he suspected they were going to do more acquisitions. And a couple of months later, got to say, mate, you were definitely right. Transforms into met coal. We know that. Nothing else here really that I haven't already said. Yeah, I mean, look at where this pro forma takes this company in comparison to its peers. It doubles the size of the company. Think of it that way, and it transfers its revenue base to almost 70% metallurgical coal. This will be the biggest Australian met coal producer by a long, long way. Is there anything else here I really feel like I need to comment, or that you guys would appreciate my comments? I don't think so. You guys can read, you can look at numbers. It's showing what their realized prices are compared to saleable production and listed price. They've done very well as far as I can tell. The types of coals in these assets. CapEx. So when you think about how much cash they can pull out of these things, their ongoing CapEx really is not that, to me, doesn't seem to be very much at all. And so if you look at 21, 22, and 23, that's where, as a result of their cash cost, that's where their CapEx ended up. So it's not too bad. And if you look at the expected CapEx that I've seen rolling around here year on year, so it's around low triple digits, so 110 somewhere like that. They're gonna have quite a decent margin, put it that way. Yeah, this is the same thing, but for the Blackwater operation. Here we go. Capital allocation and strategy. So let's see what we have here. So capital allocation. Here we go. Capital allocation, targeted payout of 20 to 50% of net profit after tax. That's an Aussie company. Net profit after tax from acquired businesses while paying down vendor finance. Yeah, so that totally fine with that. And this is what I posted on Twitter today, if you saw my comments around it. So I don't expect any shareholder returns over the next year, because they've got to pay down the bridge loan. Then they've got to pay down the cost of the acquisitions, right? So the question is, can you, as an investor, do you see the value of purchasing decades worth of reserves, decades worth of free cash? But the catch is, okay, for 3-4 times the cash flow, whatever it ends up being based on coal prices over the next 3-4 years, can you sit tight for 3 to 4 years and not receive divvies and buybacks that you used to, and then receive, and obviously discount the time value money will be important, but receive decades worth of cash flows after that? It's kind of like that marshmallow test as a kid. Now, I am a dividend roach, if ever there was one. So I totally hear the people that want divvies and divvies and divvies and divvies. Hey, that's, I live off that stuff. That's all wonderful. But a part of my portfolio is just purely based on value, free cash flow, and the ability to compound that over time. So what is it worth to you to be able to sit tight for 3-4 years and then receive decades worth of free cash or discounted free cash flows for free? Maybe that's a different way of looking at it. I'll just leave that there. Target leverage will be 0.5 debt to EBITDA at the bottom of the cycle, and then up to 2 as a result of the acquisition. Totally fine. So they're going to gear themselves up to 2 times debt to EBITDA. That's well within the realms of reason. Most investment bankers that I've dealt with in the past will go up to 3 times debt to EBITDA before they start asking questions. Any of the private acquisitions I've done in the past, if I was below 2 times debt to EBITDA, the banker just asks me how much I want. They don't really care. They'll pay that down till they get to 0.5 debt to EBITDA. And then I would presume, reading this, that then they'll go basically up to 50% of the net profit after tax as a payout ratio, where I presume by that they mean dividends using a payout ratio rather than buybacks. But I guess we'll wait and see what happens. I don't like this. Optimal cash balance on balance sheet depends on strategic priorities, alternate funding sources, point in the cycle, which means we can change that. If a quarter or a half year, we think that something else comes up and they don't want to pay out according to that, then maybe they'll use the old no, we want to keep more cash on the balance sheet, or we want to divert cash over here somewhere else. So I'm not a big fan of that. But here they have been clear. They said, look, this is the target leverage. This is the payout ratio once we pay off the acquisition. What are their cash flows going to be after the 3rd year? Let's take a look at the old Koala's numbers. So where are we? 24, 25, 26, and then the 27. And pick your number. Let's take on the low end. So 107 mil after tax free cash flow divided by the number of shares outstanding would be what you'd get there. And then you'd half that, or a quarter of that would be what you'd be receiving in shareholder returns, or a fifth of that. Sorry, fifth to a half of that would be what you'd look at. Is there anything? Dividends and buybacks. Okay, so during the preferred payment, we expect to maintain franked dividends, dividend payout ratio. Yeah, so that is, as I said before, what they're going to do. The share buyback is similarly expected to remain on hold during this period. Or no shit. You go for one or the other. So the argument, should they buy back their own shares, or should they take advantage of this sale? Well, what do you want? What do you want them to do? Do we want them to privatize the company? Excuse me. Well, then what if that's the case? Privatize the company, buy back all their shares, because remember, this acquisition is about 100% of their current business cost. They've doubled their business cost, or doubled the market cap of their business. Now they're a global. They're in the big boys league with AMR and Arch Resources and all the rest of it. So you can see here, I've sorted them by market cap. They're now there or thereabouts with the other big US names in terms of met coal. So yeah, I do think there's a case for this acquisition, because one thing people are not expecting, everyone's more towards the bearish and conservative side for met coal prices. Well, what happens if we have a little blip with a recession, and then governments just go into absolute panic mode like they did with COVID? They stimulate the hell out of everything. China starts stimulating. Chinese demand actually looks much better than what most people are thinking. What if there's a massive demand for steelmaking and therefore met coal and so on and so forth? And where are you going to get it from? South Africa? You're going to get it from Russia? I mean, the US has got their own thing going on, but met coal going straight on the barge off to wherever in Asia. I think a lot of that's going to come from Australia, personally. Okie doke. So finishing up with a couple of comments from the great Respeculator. who has agreed to come on the channel for a podcast. So very, very exciting news there. I'll keep you up to date. This summary, I think, is really good. So diversifies Whitehaven to met coal, adds material production. You can say that again. It's double the size of the biz. We'll likely see a reduction of thermal capex. Totally fine. Should present some low-hanging environment improvement opportunities, given these assets have had little focus from the current owners. I presume that's true. I don't know much about the operational sides of coal mines, so I won't comment there. But I mean, it does certainly make sense. Position as a company to have size and scale to consolidate the remaining major coal assets if and when they come to market. Ooh, yes, very interesting. And this will be where I get a little nervous as to whether the management continue to make these accretive acquisitions. If they can, okay, well, that's fine. But you do have to ask yourself at what point they would need to, or not need to, but what point they probably should hold back from further acquisitions, because given the fact that it's in the coal sector, and we've got this very peculiar thing going on in the coal sector where you don't get multiple re-ratings, you're not going to make your money on a rising share price as such. You're going to make your money from the cash that the companies produce. So if they just keep buying accretive acquisitions from now until the end of coal use, out of the free cash flows, their operations, that is it's a bizarre question to ask, but I guess you do have to ask the question. I think eventually, if they can't do these acquisitions at these ridiculously good multiples, and give them what I said will remain true, that they're not going to get the multiple re-ratings on the stock, then I think they'll buy back their own stock, or they should. And so this could certainly happen. I would just keep an eye on it. Well, it's going to be a question of price and structure. Very creative, the Whitehaven shareholders. Producing coal mines in Western jurisdictions are going to become rare as hen's teeth. I have to agree on that. So if you break down the free cash margin per share, roughly $2.50 Aussie of free cash for a stock that's now shot up to $7.50. There you go. I couldn't have said it any better myself. So, guys, check out Respeculator's Substack. I'll let you know when we can do something with the great man. And also Yellow Lab Capital have a really good read of the Koala's piece. Bear in mind, it was written on July the 3rd. So it was, in my opinion, quite a prescient piece. He put skin in the game before this thing had gone through. And you got to say he got pretty close to the valuation and the production metrics. So kudos to him. That's it. That's my take. I hope you enjoy my take. This is a rough and raw video straight on YouTube. Any questions, please do hit me up in the comment section, and I look forward to catching up with you in another video. Take care.